Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. You can resize these widgets for a larger or smaller view. You may also follow along with a PDF version of the slides that can be found in the Related Content widget. In the Related Content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Using the Reaction button, you can react to content throughout the webinar. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the Speaker Bio section, you can find out more about our presenters, including their contact information. If you need technical assistance, please use the Help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the Evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Welcome to the Art and Agony of NICRA. We're so grateful that you could join us today. We've supported dozens of nonprofits through the NICRA proposal process, and we're excited to be here today to share what we've learned and what has recently changed. I'm Debbie McLeod, and I'm a manager in YPTC's Raleigh-Durham office, and I'm joined with my colleague, Hatsie Cutshall. Hatsie, would you like to say hello?
Sure, thank you, Debbie. Hello, everyone, and thank you for joining us. I am the director of our Grant Funding and Management Solutions Department. I've been with YPTC for 15 years, and I look forward to hopefully providing some clarity to this sometimes murky topic.
Great. Before we get into today's session, let me just quickly tell you a little bit about your part-time controller, or YPTC for short. We're a professional services firm that specializes in nonprofit financial management, and we have more than 30 years of nonprofit experience. Our services include accounting, reporting, data visualization, and best practices, just to name a few. We have a team of over 800 professionals, which serve about 2,300 nonprofits nationwide. And even given our size, we do tailor our approach to meet each of our clients' unique needs, and we work both remotely and on site. We're also thrilled to have with us here today our partners from Clark Nuber, Troy Rector and Jen Keller. Troy and Jen bring a wealth of audit and NICRA negotiation experience. Troy and Jen, please go ahead and introduce yourselves.
Thank you. We're excited to join Hatsie and Debbie today to discuss federal indirect cost rate proposals and share our experience from both preparing indirect cost rate proposals and auditing indirect cost recovery as part of the single audit. My name is Jen Keller, and I am a principal in Clark Nuber's Client Advisory Services Department. I spend most of my day helping organizations with their federal grants management needs, supporting them at any point during the federal grant lifecycle, from pre-award through closeout. And I'll pass it to Troy.
All right. Thank you, Jen. My name is Troy Rector. I'm a shareholder in Clark Nuber's Nonprofit Services Group. I spend my day both leading single audits, so auditing federal grants, but also utilizing that expertise to support the federal grant advisory services focused on the nonprofit sector. And a little bit about Clark Nuber. Oh, sorry about that. All right. So a little bit about Clark Nuber. So Clark Nuber, we are a CPA firm serving nonprofits across the nation out of one office in Bellevue, Washington. We have over 300 employees, and serving nonprofits represents about 40% of what we do, including performing a large number of single audits and assisting nonprofits and state local governments in the assistance of federal awards and indirect cost rate proposal development. And as Jen mentioned, we're excited to partner with YPTC and share our collective experience and knowledge around indirect costs today.
Great. Thank you. So before we dive into our discussion, we have a couple quick housekeeping items. So first, please feel free to post questions in the Q&A widget, and we'll address those questions as we can, as we go. And then at the end of today's session, if you can stick around for an extra 15 minutes, we'll be staying on to answer any outstanding questions. And then secondly, ideally, you've already watched another video, a prerequisite session called Spring into Stability. And you'll find a link for that session in the resources listed at the end of today's program. And if you're brand new to NICRA and cost allocation, please keep in mind that today's discussion is an intermediate level. And so if you are brand new to this topic, please do watch that other session, the Spring into Stability, because it covers all those great fundamentals and details. And then finally, if you'd like 1 hour of CPE credit, please keep an eye on the attendance checks, and you'll need to respond to 3 of them. And after you respond within 24 hours of today's session, your CPE certificate will be available. Okay, so Hatsie, Jen, and Troy are true experts in this area. They're tapped into the news updates, events as they're happening, and they participate on many conferences and events nationwide. We're really excited that they're here to share their expertise with us. Today, part of the presentation will be a panel style, so we do want to hear your questions. And again, please feel free to drop those into the Q&A widget. And remember the 15-minute bonus round at the end here. So today, you're going to hear a lot of information, and NICRA and cost allocation is a topic that we could talk all day about. But by the end of today's discussion, we want you to walk away with 2 things. The first is a solid understanding of the NICRA landscape, where we started historically and what's evolving today. And then second, the practical strategies that you can use either next time you navigate a negotiation process or the first time. So here is our roadmap. We'll start with the NICRA landscape, the what, why, and what's changing, and then we'll go into the process itself, including when and how to apply, and we'll close with key takeaways and again, that open Q&A. Okay, so Hatsie, I'm going to hand it over to you to get us started.
Debbie, again, we're going to start at the beginning. We'll talk a little bit about the past, focus on present, and what we think may be happening next. We sometimes do joke about what the acronym NICRA actually stands for, and here are some of our silly ideas, but all kidding aside, it does stand for a negotiated indirect cost rate agreement. And pay attention to that word negotiated, because it's a key part of the process and a key element that you need to keep in mind as you go through the process. Now, at its core, an indirect cost rate is actually just an estimate of the indirect costs, which some people call overhead, costs like rent, IT, insurance, costs that really support all your programs and aren't necessarily tied to just 1 or 2. A NICRA is an agreement between a federal agency and an award recipient that formalizes and documents this estimate of indirect costs. The goal being to determine the true costs of running grant-funded programs so that those costs can potentially be recovered from the funders rather than the organization having to subsidize them from unrestricted resources. The formula itself, the math, is really pretty basic. It's a division, a ratio between indirect costs divided by your direct cost base. How you define each of those pools or collections of costs, that's where things can get nuanced and open to judgment. But in general, the indirect cost pool starts with balances in the general and administrative column of your statement of functional expense in your audited financials. Modified total direct costs is one such base. You may also hear it called by its acronym, MTDC. It's commonly used by many organizations because it does yield a lower rate, but it's not a one-size-fits-all solution. We talked in more detail about the various allowable bases or denominators and specific allocation methods in the prerequisite that Debbie mentioned, but we'll briefly review some of the allocation methods in bit.
So let's talk about the present landscape. What's happening right now as a result of greater scrutiny on indirect costs? For instance, HHS, Health and Human Services, lost key staff. 2 of their 4 cost allocation services offices have closed, and there are significant delays and real uncertainty in the system. If you felt like things are slower or harder, it's not in your imagination. Although much remains uncertain, federal negotiated indirect cost rates are generally required to be accepted by all federal agencies unless an exception is allowed by statute, regulation, or an approved deviation for a specific award. So those are when those exceptions exist. Troy, do you have anything to add in this area?
Yeah, so a lot of changes in the indirect cost landscape. In the 2026 Appropriation Acts, we actually saw Congress get involved. And in the 2026 Congressional Appropriation Act, it included many federal agencies included language stating that that federal agencies cannot make a change to the indirect cost rate policy unless approved by Congress. So kind of seeing that as more of a temporary measure. But what that resulted in is agencies like the Department of Energy that had issued grants policy statements limiting indirect cost recovery had to pull those back and revise those policies. One agency that is a little bit different, so in the Appropriation Act for NIH, it required that the agency update their grants policy statement to reflect indirect cost rate policies that were in effect, I believe, as of March 2017. So NIH, a month or 2 ago, issued an updated grants policy statement that made 2 changes. Number one, it rescinded the recent increase in the de minimis rate. So it rolled the de minimis rate back to 10%, saying that, okay, if you're going to charge indirect cost to an NIH award using the de minimis rate, you are going to be limited to a 10% recovery. And then also for sub-awards, in terms of how we define MTDC and how indirect cost recovery is applied to NIH awards, it rescinded the increase of the subaward threshold back to the $25,000 threshold. Because remember, in the recent uniform guidance revisions a couple of years ago, it increased to $50,000. So from a recipient perspective, it's kind of not, whether these changes or the cap survives in the court, because a lot of the policy changes we saw in 2025 were challenged in the courts, but it's kind of the practical risk that there is friction with agencies, and that there are potential changes in the future, but also recognizing to make sure that you're reading the fine print of current award terms is critical more than ever to understand how indirect cost limitations are being applied to current award agreements.
Thank you. Right. We're mentioning Executive Order 14332, which I'm sure is on the tip of everybody's tongue. But you probably heard about it when it became news early last August. It's critical to our topic today and helps explain many of the changes that we are seeing now and possibly in the future. In fact, if you heard about the recently proposed updates to uniform guidance, they pull priorities from that executive order. That order and the proposed changes apply to federal discretionary grants and cooperative agreements, not to contracts, not to non-discretionary spending. Among other things, it requires senior political appointees review grants and make decisions about making the awards rather than relying on a peer review process. There is peer review, but it's advisory only. That order also mandates termination for convenience clauses, and those got picked up in the recommended updates. Those will go into all award documents by all executive agencies, and it directs that reviewers favor applicants with lower indirect costs. The recent proposed changes actually don't change the indirect cost negotiation process or the allowable rates, but it does impress on reviewers in the pre-award process that they favor applicants that show lower indirect cost rates in their proposal budgets. The executive order, this particular executive order, outlines a fundamental shift in how federal awards are reviewed and managed. Political appointee review to ensure alignment with agency priorities and the national interest will add a new layer on top of the traditional merit-based review, which may lead to longer approval processes. This combination of the termination for convenience clause, along with the proposed new certifications in SAM.gov, if implemented, will greatly increase the risk of accepting federal awards. You may recall that there were major changes to uniform guidance. In fact, just 2 years ago, OMB has proposed a series of additional major changes. So now more than ever, it's critical that you stay up to date with the rules that govern federal funding and check back with them periodically. If the changes are implemented as proposed now, they would go into effect on October 1st of this year. So now I'm going to turn things back over to Debbie and Jen to take us through the NICRA process and the pros and cons of applying for a rate agreement.
And if I could add, Hattie, sorry, Dean, before we go, as you were mentioning, Hattie, the proposed uniform grant regulation, we really didn't see any significant shift in the indirect cost rate policy. But what I found interesting in the preamble to that proposed guidance is OMB saying that they're still looking at the issue. So I think what we kind of read into that is the story is not over as it relates to indirect cost. And our understanding is that OMB is working in the background of potential future revision. So, yeah, I think to be continued.
That's true.
Okay, so now that we have a good feel for the NICRA landscape, both historically and how the environment is changing right now, let's talk about the process itself. So you have some decisions that you're going to have to make, and I'll be asking Hattie, Jen, and Troy the most common questions that we see from clients and organizations when they get into this space. This is where we get into the details, so stay tuned and drop your questions into that Q&A widget, and we'll try to get to all the questions as we work through this. So the first question we see most often, and is probably one of the most important, is, do I even need a NICRA? So what can you tell us about that, Jen?
Great question. Yes. So the de minimis rate is now 15% as of October 2024. although some may have awards that are still operating under the old de minimis rate of 10%. So it's important to check your awards. But for some organizations, that de minimis rate is enough. And for others, it means they will be using their own unrestricted resources to make up the difference between what the funder is willing to provide and the true cost of the program. As an organization, you will want to do some preliminary math to determine what that looks like for your particular organization.
Great, thank you. So Troy, here's another question. Am I even eligible for a NICRA? Is everyone eligible?
Yeah, that's a good question. And the short answer is no. Not everyone is eligible for a NICRA. And the long answer is that in terms of negotiating a federal indirect cost rate with your cognizant federal agency and receiving a NICRA, an organization is required to have a direct award with the federal agency. So that's really kind of the key step one. So if you do not have a direct federal award or prime award with the federal agency, and instead, like many nonprofits do, only receive your federal assistance through pass-through awards as a subrecipient, you cannot negotiate a rate, and instead you would either use the de minimis rate or follow the pass-through entity's requirements. And getting back to kind of the benefit of having a NICRA is that the whole concept is that you negotiate an indirect cost rate with one federal agency. But once you have negotiated that rate with the one federal agency and receive a NICRA, all federal agencies and pass-through entities are required to accept that negotiated rate unless a program statute limits the recovery. And if you do not have a NICRA, and instead, the uniform guidance does give the opportunity to negotiate a rate with pass-through entities, but it does not have that portability. Pass-through entities are not required to accept rates that have been negotiated with other pass-through entities. So if you're having to go that route, it means that you may have to go through multiple negotiation processes if the pass-through entity will even negotiate a rate. And I think that's why for most of our nonprofit clients, if they do not have a federally negotiated NICRA, they fall back to the de minimis rate.
Great, thank you.
Okay.
All right.
Sorry. So before we dive into the NICRA process, it might be worthwhile to step back and ask some fundamental questions, kind of the key considerations in determining whether this process is right for your organization. First is administrative burden. Applying for a negotiated NICRA is time intensive. You're already managing federal awards day to day and managing the compliance risk. Layering on a full negotiation process is a real resource commitment, both from a staff resource, but also technical resource. And oftentimes it's that latter that organizations find that they're short on. Next is the cost benefit. Let's say your actual indirect cost rate using the MTDC is 17%. Is it really worth the time and effort recovering the additional 2% above the de minimis rate? For some organizations, the answer is absolutely yes. For smaller ones, it may not pencil out, but it's tricky. If your organization's indirect cost rate is 17% today, this year, and the decision is not to pursue a NICRA, what if your rate goes to 21% next year? So the economics can certainly change year to year as your cost structure shifts.
And third, stability. A negotiated rate can be locked in for up to 4 years, and it carries more authority than agency preferences, unless, as we mentioned before, those preferences are backed by federal statute, regulation, or OMB approved exceptions that predictably can be very valuable. And finally, continuation of funding. Ask yourself whether grant funding is a long-term part of your strategy. If yes, the investment in a NICRA typically pays off over time.
Great. So now that we have determined, I think I want a NICRA and I am eligible for a NICRA, Hatsy, what does the NICRA process entail?
Well, you probably won't be surprised to hear that it can vary somewhat agency by agency. So what you're about to see is a general roadmap, but as mentioned, every agency and every situation will have its quirks. Now, this assumes that you've done the analysis that we talked about previously and confirmed that a NICRA would be a good idea and worthwhile for your organization. It's worth the effort, as well as whether your organization is eligible. So step one is to first identify your largest direct federal funding source. That will identify what's called your cognizant agency, and that's the agency with whom you'll apply for a NICRA. As we alluded to, if you're receiving all your federal money as a subrecipient, then you cannot negotiate directly with a federal agency. You have to have at least one federal award as a direct recipient. Next, you want to make sure you're using the right resources or format and the preferred process for that cognizant agency. You'll prepare a proposal to include usually a cost allocation plan. As we mentioned, that is the essence of a NICRA proposal, as well as whatever other support documentation the agency requires. After that, once it's all ready, then you'll submit the proposal to the agency in the way they prefer, and be prepared to wait for at least 6 months, quite often longer, before they pick that proposal up to review it. Once they do, in most cases, they'll let you know, and they will be asking follow-up questions. So as you hear from them, be sure you respond to those questions quickly so that they can move through the review process as quickly as possible. And then finally, once that rate is approved, that rate, as Troy mentioned, applies across all federal agencies unless there's a specific exclusion. Troy, did you have any other additional thoughts on this process?
Yeah, and Hatsy, as you mentioned, agency response times can be slow. And we're certainly hearing that and seeing that from rates negotiated with Department of Health and Human Services, Department of Interior. But while the agency response time can be slow, it's important to keep your own deadlines in mind. So oftentimes organizations negotiate their first indirect cost rate because they have budgeted for a higher rate recovery and an award. I mean, if that's the case, most federal agencies require that that the indirect cost rate proposal is due within 90 days after signing that award agreement. And once you have a NICRA, most federal agencies do require an annual indirect cost rate proposal submission, which is due along with the audited financial statements within 6 months of your entity's fiscal year end. So, oftentimes, if your indirect cost rate proposal is submitted late, your negotiator's review may be delayed too. So it's really important to keep the submissions timely in order to keep your rate current. Most NICRAs do have expiration dates on rates, and so to keep those rates current and active, making sure that you're submitting your proposal on a timely basis.
Great. Okay, so I've decided I want to pursue obtaining a NICRA. And Hatsy, help us understand what is involved. How do we actually prepare that cost rate proposal?
Okay, well, before I charge in, Troy made me think of something. If you're late submitting your proposal, there's no penalty, but as Troy mentioned, there can be additional delays if you're late. So requesting an extension is not only a courtesy to the cognizant agency, but also a way to help them plan for and get a better idea of when they'll take up your proposal. So as alluded to, there are a few different approaches to preparing the cost rate proposal. The math is approximately the same, but the right one depends on your organization's operations. As we've alluded to, a NICRA essentially documents your cost allocation plan in a format that the feds like to see. There are 4 main cost allocation methods. The simplified allocation tends to work best for either smaller organization or maybe some larger organizations that only have 1 or 2 different primary programs. Then there's direct allocation, and that one skips the indirect pool entirely. It's a good management approach because by doing that, you show which programs are actually covering their full cost, but it also can make it harder for a reviewer to see the makeup of the indirect cost pool, and sometimes makes work at year end because you do have to show G&A in the statement of functional expense for your audit. Then there's a multiple allocation base, and that lets you split costs into different pools that get allocated using different methods. For instance, you might allocate rent and other occupancy costs by square footage, if that makes sense in how you operate. Other costs may make sense to be allocated based on the percentage of time that your employees spend on different programs, fundraising and the G&A that we talked about. And then there can be special rates for unique federal awards with unusual factors like research and remote areas, things like that. There is flexibility in how indirect costs can be structured, but every method comes with trade-offs. The simpler approaches are certainly easier to manage and administer and explain, while the more tailored methods may better reflect your true costs but require more work and documentation. Whatever method you choose to use, the costs allocated must be allowable, allocable, reasonable, and applied consistently across all your cost centers. The key is choosing a method that balances accuracy, the level of effort, and make sure your funders will allow it as well. Debbie and Jen are now going to talk about what to do when your calculated rate is different from the rate that ends up in your NICRA document.
Okay, thank you, Hatsy. So we've covered the methods, and at this point, you might be wondering, so why is my calculated rate different than my negotiated rate?
Yes, this is where it gets real. Your calculated rate is your starting point, not your finish line. It's not necessarily what you're going to be granted as your negotiated indirect cost rate. Expect variation and inconsistency. The agency may reclassify costs from direct to indirect, disallow expenses, or require a different allocation base. For example, if you requested salaries and wages, they may push you towards modified total direct costs. So there are changes that you can expect. Remember, as you put together the proposal and classify costs throughout the year, every cost has to be reasonable, allocable, and allowable. And during the negotiation, the agency's interpretation may differ from yours. Remember, the N in NICRA stands for negotiated. So we just want to make sure that we have a very clear proposal that they can follow with formulas, and it's very explicit, and that you have your reasoning outlined so that you can easily defend it.
Great, thank you. Okay, Troy, what else do we need to be aware of?
Yeah, so some of the factors that affect the negotiation outcome or the application of a NICRA rate is the uniform guidance specifically says, again, we're saying that federal agencies and pass-through entities are required to accept your negotiated rate unless a statutory or program cap exists. And so some programs have legislated ceilings on indirect cost recovery that limit recovery even if you have a negotiated rate. But remembering that each of the program caps are a little bit different. Sometimes the rate cap caps not only program admin that can be charged, but also indirect costs. I've seen other rate caps that only apply to program income and actually don't have anything to do with indirect cost. And so really understanding what that rate cap is. And in theory, the uniform guidance requires that if a rate cap exists, it's required to be identified in the notice of funding opportunity. Another thing is, as a subboard agreements may try to impose the lower rate caps, but again, the uniform guidance prevails if we're looking at federal award. So even though a pass-through entity may not be willing to negotiate a rate with you, they cannot impose a rate cap lower than the de minimis rate. But beware, sometimes education is needed on the part of the pass-through entity if you're a subrecipient. So just making sure that you're kind of stepping through that process in the budget negotiation. And sometimes it does take providing the uniform guidance excerpts for the pass-through entity to make sure they understand what their responsibility is. And the last item here is that rate types matter. And so when we look at the uniform guidance, there are several different types of rates that are available. For many nonprofits, you will be provided what is called a provisional rate. So that is it's a budgeted rate, and once your numbers are finalized for the year, you will be required to submit an indirect cost rate proposal that finalizes that rate. And if that final rate comes in lower than the provisional rate, you may have to go back in time and do a downward adjustment to previous amounts billed. Another type of rate is a predetermined rate. This is kind of like a provisional rate, so based on budget, but not subject to future adjustment. So locking in a rate, which is great if your rate is consistent, but what if your actual indirect cost rate starts to inch higher than that predetermined rate? Well, it's locked in. The other type of rate that we see is a fixed carry forward rate. It's kind of like a provisional rate, but instead of doing a retroactive adjustment to what your final numbers are, that over recovery just gets kicked forward a couple of years and impacts the rate in the future years. And again, the federal agency will mostly determine what type of rate they're going to provide, although you probably could request a predetermined rate. And with that fixed carry forward rate, we typically see that with tribal governments, and then maybe with some larger research institutions will utilize a fixed carry forward rate.
Yep. Thanks, Troy. So you just threw around a lot of different language for rates and what kind of rates and all that. And I just want to underscore how important it is to understand the type of rate you have, and that a negotiated rate is just that, and you still need to track your actual rate throughout the year and at year end. And I remember in my audit days talking with someone from a federal agency who said, the whole purpose of this is to recover costs, not to make a profit. So if your actual rate comes in lower than your provisional rate, it's you don't get to just keep the money. So I always remember that one.
Yep.
Okay, so you've reminded us several times today that this process is not a guarantee, it's a negotiation. And can we at least count on it being a standardized process?
Well, as with so many things with the federal government, the answer is yes and no. There are many complexities in the process, as we've covered. And to add to all that fun, not all agencies work the same, despite the fact that they're following supposedly uniform guidance. You can see on the slide, HHS has their own way of receiving your proposal through their online portal that they call ICAS. You do have to set up an account to use it. That's the only way they will receive proposals. Department of Interior goes through what they call the Interior Business Center, and they ask that proposals be sent in by email. So the logistics can vary, as well as the formats that are used. The math is very similar across all agencies. But we do want to share some key tips with you to help navigate this process. And that's one of Jen's specialties, so she's going to take it from here.
Thank you. So yes, tip 1, utilize a subject matter expert. First, engage them. You want someone who speaks the language and can advocate on your behalf, including participating in phone calls with the negotiator. Sorry. 2, if things stall or escalate, you'll want to have them there for those discussions as well. An indirect cost branch chief can intervene, though be aware they are sometimes part of the issue. Also engage OMB's Office of Federal Financial Management, though note that OFFM leadership has changed multiple times since the Giltran era, Giltran being the father of the uniform guidance. And so there may not be consistency in thought amongst that leadership either. Plan for delays. Staffing shortages and agency turnover have made timelines unpredictable. For the Department of Interior, we are seeing about a 6 to 7 month wait time just to be assigned a negotiator in order to start the negotiation process. So those wait times are real. So that's, again, to start the negotiation process. And then from there, then you go through the negotiation where they're combing through your documents and asking questions. So that would just be the start, the wait time there. 4, leverage your community. Industry associations can apply pressure. Congressional delegations can be contacted, and peer organizations may have been through this before, so you can always lean on them. Even with strong arguments, the negotiation may still result in changes to existing methodology. If the negotiator insists a cost should be direct rather than indirect, help your organization revise their cost allocation and grant budget methodology to recover it as a direct cost. And keep a running tab of all of those issues where maybe you've been able to do it before and now all of a sudden you're running into pushback, so that next year or the next time you negotiate, you can try and defend and have that more consistent with prior years. So that you can go back to that, circle back, and try and have your next negotiator see it the way that you have traditionally applied for your rate.
Great, thank you.
And then tips for conflict resolution. So when disagreements come up, and they will, keep these strategies in mind. Address the issue, not the individual. Stay focused on the substance. Treat each step in communication as important. Respond timely and respect the agency employee's time. Treat this as a negotiation, not a judgment. It's called a negotiated rate for a reason. If the negotiator insists something isn't indirect, explore direct cost recovery. Review and revise your allocation and budget methodology in court accordingly. But again, keep that list of those issues and revisit them during your next negotiation. As time goes on, you may have a different negotiator who will acknowledge the logic behind your reasoning for including a cost as indirect or allowable. And then don't give up. Remember the long-term benefit to your organization and that the process is worth completing.
All right. So we've talked a lot about moving to a NICRA, but if you have a NICRA and it's going to expire, should we think about moving from a NICRA to the de minimis rate?
Yeah, Debbie, that's an interesting question. You know, with the increase of the de minimis rate from 10% to 15%, that question is certainly coming up more often. You know, if your rate is currently calculating higher than 15%, as Hattie mentioned before, or I think Debbie did, we cannot make a profit on federal awards. As you guessed, it depends. You know, the goal for indirect cost recovery is full cost recovery on awards. But that is definitely a question that's coming in more often. Hattie, what are some considerations that that you're seeing, or what insights do you have in terms of organizations that are asking this question?
Well, in fact, we just worked with a group that decided to keep a NICRA, even though they don't have any federal funding on the horizon, because they want to be prepared to be able to collect the full amount, the full costs on their awards. So even though they know they're going to have to finalize a rate next year, they decided it was worth the effort to be prepared for opportunities coming up. But we all, similarly, as you've mentioned, we see groups that will, if their true rate comes in close to 15%, they say, heck, it's hardly worth the administrative effort. So we see it go both ways.
Okay. So are there other factors we should be thinking about, like, for instance, audit risk or audit cost when you're thinking about pursuing a NICRA?
Yes and no. This is really a question for, I think Troy was going to follow up on this, and he's going to outline some additional considerations, because it is part of, especially of audit process, whether you're getting a financial audit or a single audit, and that's what he does day in and day out. So let's hear from him.
Yeah. So on the next slide, we've covered some audit considerations. The first point is more related to transitioning from a NICRA to the de minimis rate, and then the last 3 points are really looking at okay, once you have a NICRA, how is that audited in a single audit? So how would your single audit change? And so first, if you're transitioning from a NICRA to the de minimis rate, auditors will be testing to ensure that you properly apply the rate that was in effect when that cost was incurred. There will certainly be a definitive cutoff date. So ensuring that you have internal controls in place to make sure the correct rate is being used. Conceptually, that's pretty easy to understand, right? But I find in practice, because a lot of billing practices, how you recover indirect cost rates are a manual process, we are finding errors. So the common finding is, okay, you transition to the de minimis rate, but for a period of time, you're still applying your old NICRA. So making sure that you get that cutoff correct. So assuming you get that cutoff correct, but you're now kind of transitioning to, if you do have a NICRA, how is the NICRA audited as a part of the single audit? First is application of the NICRA. So in the single audit, we will test samples of requests for reimbursement or federal financial reports, and we're simply checking the math. We're simply looking at the direct costs that were incurred or reported, and ensuring that your rate was applied appropriately according to the terms in the NICRA agreement. Secondly, the OMB compliance supplements, which is followed by auditors and provides suggested audit procedures. It does have us test the cost in the indirect cost pool for that period of the audit. So for auditing, let's say calendar year 2025, we're going to request the population of costs that you anticipate on reporting in your 2025 indirect cost rate proposal. And we select a sample of those costs or review those costs for allowability. And so ensuring that costs are being charged to the indirect cost pool in accordance with the allowable cost provisions of the uniform guidance, and also being charged consistently between directly to the federal awards or the indirect cost pool in accordance with your NICRA agreements. And then last but not least, when we talk about the rate settlement, again, most commonly, nonprofits will have provisional rates. So what we focus on is for any final rates that were issued during the year under audit, we inquire with management in terms of what is your process for, if that final rate comes in lower than the provisional rate, what is your process and efforts to going back and evaluating where there may be over recovery? And sometimes the question is, okay, well, what if we do have over recovery? What's that process? The short answer is there is no established agency-wide easy process. It really requires you to go back grant by grant and determine if over recovery exists, and if it does, working with that grantor to determine, okay, do you want us to pay this back, amend prior financial reports, or do you just want us to maybe reduce a current award by the over recovery? So it's really kind of grantor by grantor in terms of what that process looks like.
Great. Okay, so we have covered a lot of material here, and believe it or not, amazing, we are right on time. So let's bring it all together with some key takeaways. So just very high level summary here. Where do we start? We start with evaluating our current indirect cost recovery. And then we assess the readiness. Do we have the policies, the documentation, the things we need to have in place? And then third, we identify any gaps in cost, clarification, or consistency. As our experts have mentioned, that costs need to be treated the same and equally. They need to be allowable, allocable. So are we seeing consistency? Do we need any clarification? And then fourth, we can compare. So what would a NICRA give us versus the de minimis rate? And if there is a spread or a window, is that big enough to really make the difference? And if we think it is, well, then we pursue the NICRA, and we're going to plan very early. And so we are at almost 53 minutes. So at this point, we would sure like to thank everybody who joined us today. We hope that this was informative and helpful. We know it's a lot of material, but it's really great information. And so if you need to leave, again, thank you for joining. And for those of you who can never get enough and who can stick around, we would like to address some of the questions that you dropped in. All righty. So for our team of experts, do you see any specific questions that you're dying to answer? Or I can just start reading off some of the questions.
I noticed a lot of questions about pass-through entities and whether pass-through entities are required to negotiate rates with their subrecipients. And the answer to that is they're not required. It is an option that they may offer, but they're not required to negotiate the rate. And then keep in mind that although you may negotiate a rate with that pass-through entity, other pass-through entities are then not required to accept that. Sometimes they will, because they know that if a pass-through entity is willing to negotiate a rate with you, that they probably have experience with that. When I see that happening, it's usually with a state or a very large prime recipient. And so other organizations in the environment probably know them and would have some confidence in the work that was done, but other entities do not have to accept that rate. So you may be negotiating specifically with that institution specifically for that award.
Great, thank you. We've got a really good question here. I thought the proposal was due within 9 months of year end, same as the FAC submission due date.
Yeah, good question, Debbie. And that is going to be an agency by agency requirement. I know Health and Human Services requires the proposal to be submitted within 6 months after year end. Each of the major federal agencies that negotiate indirect cost rates do have an indirect cost rate guide. So it would be mentioned in that guide, and just making sure that you that you understand what that due date is. Oftentimes the preparation of the direct cost rate proposal is maybe not the larger challenge. Sometimes the larger challenge is getting your audit done, an issue within that period of time. So,
right.
Yeah.
Thank you. We have another really good question here. What is the tipping point in terms of the amount of federal dollars or percentage they represent in your budget to trigger the process for a NICRA? So I know y'all are going to say, well, there's no hard and fast rule, but in general, at what point does it really become worth your while to start looking into negotiating a rate?
I would say even if you have a single award, perhaps if it's a single year award, it probably isn't worth a negotiation because the process can take more than a year. But we've talked with a number of groups that have received 3- and 5-year awards and have accepted the de minimis on the first year, sometimes 2, long enough to realize that they are subsidizing the indirect costs. And if you've got a few more years, even on a single award, and you realize that you are losing money, not able to recover your full costs, then that would be a reason to negotiate. That's been our experience as well.
Yeah, and I completely agree, Hatsy, and I think Jen had covered this of the importance of calculating what is your rate. So even if you're currently utilizing the de minimis rate, calculating, what is your entity's actual effective rate. I know a lot of my clients in the pre-award kind of proposal application process, they do monitor. What awards are budgeting recovery that's potentially over or under the de minimis rates, or if your entity's actual rate is trending over the de minimis rate, that's a real cost and a real deficit that needs to be covered by your unrestricted resources. So really monitoring. Calculating what is your actual rate and identifying what that means for the deficit that's going to need to be funded with fundraising and unrestricted resources. So,
I agree. I have some entities that are at 16 or 17%, and they elect to just use the de minimis because they don't feel that is worth negotiating for, but that 1 or 2% difference for another entity, a smaller entity, may mean the world. So it really is a case-by-case basis.
Great.
Debbie, I hope I'm not interrupting, but I'm seeing a question about an organization that's doesn't receive any direct federal funding, but gets a number of subawards from municipalities or local government that insist on using rates below the federal de minimis. And we run into this all the time. Unfortunately, I've watched webinars over the years, and this question comes up repeatedly. So states and localities don't always know their role or really don't care. They may have a cap by policy at the state level to keep indirect costs at a certain rate. So if that's the case, you can push it by going to your own congressional representatives, but that comes with political risk as well. So long-term solution may be to see if the funder is willing to let you do a budget modification that essentially moves, some of your indirect costs up into the direct cost lines. We've seen some awards recently where the funder would accept essentially a direct allocation of all costs as direct costs. So it may feel a little bit like gaming the system, but that may be the only way to recover your true cost.
Yeah, exactly, Hattie. And in remembering that the uniform guidance does require consistency in the application of methodology. So if you do go with the direct allocation method where you're coming with an allocation plan that directly allocates all G&A costs, then that's what you have to stick with. And so the guidance doesn't want you to flip-flop between maybe the de minimis and the direct allocation. So I know sometimes with the direct allocation method, that's kind of the challenge because you can get to full cost recovery without a NICRA, but not all fund agencies will accept that methodology. So definitely tricky.
So how would it be, this goes to my final rate is different than my provisional. So how would it be possible to go back in time and adjust the rate if you've closed your financials for the year?
Yeah,
go ahead, Troy. Yeah.
Okay, yeah, I can maybe do an initial comment on that. So let's say your financial statements are closed and, more importantly, the grant is closed for that period. There is a provision that if you become aware of any adjustments, that have a downward adjustment to the costs that were claimed, you do have the responsibility for going back and contacting that grantor. And so, in terms of the impact on the financial statements, I know commonly organizations will, at the end of the year, identify what they expect or estimate their final rate to be. And if that is lower than the provisional rate, they will adjust revenue recognition and record a liability if they recovered over what that final rate is. But if they haven't done that, you're in the year where the adjustment is going to take place, that could be an expense if you're having to pay funds back. Or at the least reduce current year revenue if the grantor requires you to offset any current year reimbursements that you had sent and recognized.
Right. So it's like two issues. One of them is if you do owe money, getting a liability recorded on your books, and then the actual method for, quote, paying that money back. So, let's see. Is there a process to elect a 4-year NICRA versus negotiating a new rate every year? In case of a 4-year rate, is there a true-up exercise to reconcile the cost charged to the grant?
What do you see, Hatzie, with your clients?
We are having more and more clients ask about that recently, and in some cases, the first thing we do is the analysis of what their historical rates have been over the past 3 to 4 years, and if there's quite a bit of variance among those rates, we will advise them not to go for a 4-year rate because they may find themselves shortchanged in one or more of those years. But if the rate tends to run very consistent within, a less than a full point or two variance year over year, then we advise that we can request that from the agency. Some agencies seem very prone to do that. Others want to stick to the annual finalization process. We're seeing more and more agencies provide at least 2, often 3-year provisional rates, which means, of course, you still have to finalize every year, but at least you have a guideline. And if your finalization process reveals that your rate has changed significantly since the last finalization, then that's a reflection that a longer-term rate maybe isn't the best fit for your organization. I think it was Troy that said that The fixed with carry forward rates are better applied in tribal or other governmental situations, but for smaller nonprofits, we tend to recommend the year-by-year approach so that you have the opportunity to adjust your rate if your operations are yielding a significantly higher or even lower rate.
Absolutely, I agree with that, because if you're running higher or lower and have a big swing in your rate, then I think that has a lot of implications for whether you're actually recovering your full costs if your rate swings below, or whether you have a large payback if your rate, other way. If your rate swings below, whether you have a large payback potentially, or if your rate swings above, whether you're receiving full cost recovery. So keeping an eye on that closely is really important, just to make sure that you are recovering all of your costs as best as you can.
Great. Do you know what agency is handling DOE NICRA proposals?
I believe that is Department of Interior.
I think it varies within the agency, because we are working with DOE direct. I assume we're talking about energy, not ed.
Yes, yeah, I think.
Yeah. Some of the divisions of DOE are going to Interior Business Center, and others are asking us to work directly with energy. So again, that's the government's definition of uniform guidance.
Okay. If a multi-year predetermined indirect rate is awarded and the actual indirect rate for one of those years is less than the predetermined rate, is the grantee allowed to be reimbursed at the greater predetermined indirect rate? So multi-year predetermined rate, and if in year one the actual rate is lower, can you continue to recover at the predetermined rate?
That seems to be the case, even with that predetermined rate for multi-years, you still have to finalize every year. At least that's what we've seen. What about you, Jen? What's your experience?
Yes, and I have seen organizations try to take the lower amount, so they wouldn't have to pay back anything and they wouldn't have to record a liability on their books, but actually whatever portal they were doing their SF425, their final financial report in, it physically would not let them plug in the lower rate, and it insisted on keeping the rate that was negotiated, or it would not let them submit the report. So I think you may actually be locked into taking that rate, depending on the agency you work with, and then potentially needing, when you finalize, having to go through the process of paying that back.
Yep. And Nancy, I have seen NICRAs with predetermined rates that do not require a subsequent indirect cost rate proposal adjustment, and really relies on the guidance, and the uniform guidance says predetermined rates are not adjusted. So it's I think that's one of the considerations for both nonprofits, but also the federal agency in entering into that predetermined rate of you are kind of locking in that rate. So good or bad.
Okay. Would engaging a CPA auditor help an organization get a preferred NICRA?
I know that the Department of Interior had issued a guidance letter a couple of months back. And, one of the things that they mentioned is when they're taking in an indirect cost rate proposal, the timing of when they're going to review and how long that review is going to take, they are considering whether an experienced consultant assisted the entity in preparing the proposal. Kind of suggesting that from a risk assessment standpoint, if you are working with an outside subject matter expert, it does reduce the risk. And so I wouldn't say a CPA independent firm in terms of helping you prepare the proposal, but working with a subject matter expert like YPTC or CN does help the process, and agencies are recognizing that. So what I came away when I looked at that Department of Interior letter is if you are working with an outside expert to help you in that process, making sure that it is identified in the proposal submission letter so that the agency is aware and kind of adjust their risk assessment accordingly.
Okay. Let's see. How about one last question, because we're getting very close on time here. Could you share a range of NICRA rates that your medium to large size nonprofits typically receive?
Well, I'll start there, and my caveat is always to look at what base is the organization using, because they may reflect a relatively high rate of 40, 50, even higher percent. But if they're using a base of direct salaries or even salaries plus fringe, that's going to be a smaller base or a smaller denominator when you do the math than if they were to use modified total direct costs. So it all hinges on how you do the math, and it gets confusing because there are these different allowable bases that can yield different rates for the same indirect cost pool. I'd say most of our clients opt to use modified total direct costs, in fact, because it does yield a lower rate, which they feel makes them more competitive. Now, it does take a lot more work to keep up with, especially if they have subawards or participant support costs or other costs that are typically excluded from the MTDC base. So that would be my first question, would be we usually, for a first-time applicant, we usually explore the different bases, what rates they yield, and then have a conversation with the client to see what they prefer to do. Jen, what about your work?
Yes, I think that's a very good point. I would say you shouldn't really compare yourself, but others will. You shouldn't really compare yourself because it's your entity. Your entity is unique. I would say for a medium-sized organization, I'm seeing mid-20s to mid-30s as a range if you're using modified total direct cost. But again, it's your organization. You may be unique in that you have many subawards versus someone who doesn't. So it's very much a case-by-case factor, but it is definitely something to keep in mind, because although we say you should never compare, you're unique, others will. And in fact, that's one of those changes where people with lower indirect cost rates may get preferential treatment on indirect costs, on future awards. So it is something that unfortunately we do have to keep in mind.
Great. Well, thank you. So we're really out of time here. So thank you again to everyone who joined us today. And thank you, of course, Hatsy, Jen, and Troy. Thanks so much for sharing all your expertise and information. And we'll see you next time. Thank you. Bye-bye.
Thank you.
Bye-bye.